have to do one by one. Just listen to this carefully, okay? Because after this, I'm going to test you and you better get 100%. Otherwise, I'm not going to be happy. Okay. How to calculate taxable income. Now, let me just explain. In Australia, our financial year is very funny. It's from 1st July to 30th of June. So we work out the income that we earn from 1st July to 30th of June. And how we work it out, our taxable income, is we have assessable income. Assessable income, less the allowable deduction, that like expense that you can claim, then it's equal your taxable income, then you pay tax on that. So let me explain to you what is assessable income. Okay, so remember I explained to you already that we have three types of income. The income from personal exertion, that means like income that you work as an employee or as a commission base or allowance or salary and wages. Then we have income from property, income from like interest, dividend, rent, royalty, annuity. And then we have income from business. So this is all assessable income. And we have to add all that income plus your capital gains. And that would depending on if you hold a property, say if your capital gains, if you're entitled to the 50% discount or not. Say you make a capital gains of 100,000, like you sell your property and then you make 100,000 and you can get 50% discount, then only 50,000 will add to your assessable income. Then you pay the tax. But if you're not allowed to claim that 50% discount, then you have to add the whole 100,000 plus all other income, and then that's become your assessable income. So that is going to be a lot. Then that's the income. And what is allowable deduction? It's deductions that you can claim for tax. And I'll sort of run through a little bit slowly here. You have deductible. That means like, what it means is like you can claim from tax. That means that you can take it away from your income, take it away from your assessable income. So your taxable income become less. The lesser the taxable income, the less tax that you pay. So the allowable deduction is very important. And so the tax government here, they have strict rule like what you can claim, what you can't claim, and so we have to learn all this. And basically, if you work as a salary and wages, like as an employee, then there's certain things that you can claim. Like for example, if you have to wear work uniform, or you have to work, you have the protective clothing or safety clothing or tools and equipment, that anything that help you to earn your assessable income, then you can claim as allowable deductions. And example, like people have to work outdoor, like for example, gardener or people that they have to be on the sun all the time and they need sun cream, they need sun protection from the skin cancer, whatever. They can claim that as an expense as well. The car is a little bit I'm sort of like explain here very briefly, but traveling from home, say if traveling from home to work, you can't claim that expense because the government say that's for personal. You need to go to work. So when you travel from home to work, that's a personal expense, so you can't claim. But if you have, if you're working in a job, then you have to drive the car to visit your customer, your client, or you have to go to the bank, post office, or you have to use the car for business purposes, then you can claim that car expense. And there's 4 different ways of claiming. I'm not going to go into that detail, but claiming the car, they have a certain rule and regulation that we have to follow, and we have to keep logbook and so forth. And also, if you make donation, gift, you can also claim that as a deduction as well. Or if you run a business, then anything that will help you to produce your income, then you can claim as a deduction. For example, Warren has to pay you guys a contract fee to do his work, and that's necessary incur in earning his income. So therefore, those expenses are allowable deductions. So he can claim that to less his income, so he pay less tax on that. So he has to keep the proper receipts and that how much that he pay to you as an expense. So that's necessary incur in earning the income. Okay, and then the government say other expense. It's not all the expenses that you can claim. Not all. Anything that relating to capital nature. For example, if I have to go to uni and study accounting to get my degree at the beginning before I got the job as an accountant, I can't claim that as my expense. I can't claim that because that's my capital, because I need to go to uni to get my degree before I can become an accountant. But now I'm accountant, but I need to update myself every year, how the tax, how the everything work. And I have to go and do more courses or conferences or seminar or so forth because I already earning income as an accountant. So those expenses I can claim. Do you get it? And I'll give you another example. Is like people never own a property before. Like for example, they have to traveling to USA or to Philippines and they want to go and buy property there. But they never owned the property in that country before. They're just gonna go and have a look and see if it's a good investment and they're gonna buy. So that is more like a capital. So they can't claim that trip. But if they already have the property there in Philippines or in US, and then they have to go there and to maintain to look after the property, then the trip that they travel there they can claim. So this is very important. Like you have to make sure that is this capital in nature. If it's capital in nature, then you can't claim. Or legal costs, setting up business, you also can't. And also anything to do with private, like for example, you have to wear your, say if you have to wear your normal clothes to go to work, it's not a uniform, it's not a protective clothing, and everybody have to wear clothes to work. I mean, otherwise you have to naked. So you have to wear your clothes, so you can't claim, okay? And child mind, or traveling from home to work, or food or drink, like you have to eat, you have to have lunch or hairdress. This is all private, you can't claim. Anything that deriving exempt income, you can't claim. There's certain things in the act. It's very funny in Australia. It's like even though they say, for example, you have to take your customers to dinner so that you can get more business. But if you classify that as an entertainment expense, then you're not going to be able to claim. So depending on the classification, how you put it, it will determine the nature of the expense. So it's a really it's like an art. It's like the when you know about the tax, it's just like a game. It's just like a tax game, and you just have to know the rules, and then you apply, and then you just play. It's just like a game. Okay, so you have your assessable income less allowable deduction, then it's equal your taxable income, and this is the taxable income is the tax that you have to pay. So after you calculate, you got your taxable income, then you work it out how much tax I have to pay on that taxable income. This is where the difference is. Like if you are a resident, you know how we discussed, you have to declare income inside and outside Australia. You add it all up, and then you get a different tax rate. Like to show it to you here, just let me make sure that you can see. Basically, if you are a resident for tax purposes, then the first $6,000 you don't have to pay tax. But then if you earn between like 6,000 to 37,000, then you have to pay 15 cents for each dollar that over 6,000. So to work it out, the tax payable is very simple. So say if you earn 30,000, then what you do, you got 30,000, take away 6,000 times by 15 cents, and that is your tax that you have to pay. And then you have to plus the Medicare levy of 1.5% of that 30,000, and that's the total tax that you have to pay. And then if you earn between 37 to 80,000, then anything that you got 4,650 plus anything that over the 30, say for example you earn 50,000, then you got 50,000, take away the 37,000 times by 30 cents, then you plus the 4,650, and that is your tax payable. Okay, that's how the system here works. It's progression. The more you earn, the more tax that you pay. And if you earn, you can get up to 46.5 because the top tax marginal rate is 45 cents plus your 1.5%. That's 46.5. And if you don't have the private health fund, then you pay 47.5. And then if you add up all other taxes that you have to pay, you probably end up paying like 70% or 80% taxes in Australia. So virtually, if you don't know how to do the planning properly and you don't get the accountant, top lawyer accountant like Warren, then you're going to pay a lot of tax. If you're a non-resident, okay, if you're a non-resident, then it's a little bit different. So let me just show you the non-resident rate. Okay. As you can see, if you are a non-resident, right, you only have to declare income that you earn in Australia. But you don't get that 6,000 tax-free. You have to pay the tax on the dollar up. So if you earn 37,000, then you times by 29 cents. So it's more tax that you have to pay than the resident people. Because you are a non-resident, you don't get the tax-free threshold of that 6,000. Okay, so the tax is work out to be similar. The formula is like if you earn 50,000, then you get 50,000. Take away 37,000. The difference you times by 30 cents. Then you plus 10,730, and that's your tax that you have to pay. And if you go into the tax ATO website, they have a calculator there that you can just plug in the figure and it will work it out for you. Or you can just using this table and you can work that out. It's very simple. It's not hard. Okay. Then what happens is that after you work it out, your tax, then you plus your Medicare levy of 1.5%. And if you don't have a private health fund, then you add another 1%, like what I just explained earlier. And you less any offset. Offset is just like a rebate. They reduce your tax that you pay. And we have like in here, we have like if you incur medical expenses more than 2,060 this year, then anything over that you can get 20% about that as a rebate. That means that it will reduce your tax payable down, so you don't have to pay that much. Or if you have low income or mature age or dependent tax offset. I'm not going to go into details in there. Exempt income is income that you don't have to pay tax. And what are there is like, if you receive child support payment, it's not taxable. School scholarship or family assistance allowance, or somebody give you gift, gift or loan, that's no tax. If you're lucky, you gambling and you won from the casino with gambling, it's not taxable. Or money that you receive from lottery or gambling, that's not taxable, or personal gift. So basically, this is so exempt, so you don't have to pay tax on that. So it's good to win the lotto. I wish I can win that 30 million this 30th of June. Okay, what I'm going to do, I'm going to test you first, okay? And then you can ask me question. Okay, now what I want you to do, I just want to test you. Can you please go and answer those questions for me? Please, thank you. Oh, yeah, I got it all, 100% vote. Okay, good. Let me just share this with you. So, what do you think is the right answer there?
Number 2.
Yeah, that's right. Number 2. Whoever the answer...
Yay.
That's good. Number 2 is the right answer. So, I just want to test you that you're not sleeping and you're listening to me. Okay, all right, good. That's right. So you got it all right. So it's assessable income less your allowable deduction. It's your taxable income. So you're all listening to me. I'm happy.